Joining me now, Erik Hirsch, Hamilton Lane Vice Chairman, Head of Strategic Initiatives. I've known this guy for a long time.
Good to see
Before you were this important. This is amazing. You've got sort of this whole outlook. You look at private equity, you guys have, you were in touch with investors all over the world. So take us inside their minds, especially in a market like this that over the last couple days has reintroduced volatility.
Yeah, it's interesting. One, PE has actually done quite well over the last couple of years, but you're chasing this public market that has been just absolutely on a tear. Historically, that's not been a great environment for private equity. Even though it's still out delivering, it's not been a great environment for them. When you start to introduce volatility and you start to see some pricing come down, that's typically where private equity excels, and we've seen that historically.
Right, because valuations have been one of the toughest gating factors here, right?
You've also not seen one of the big weapons that private equity has, which is take privates.
Yeah.
No one's going to do that in a market environment where people already feel like stocks are trading at a premium to value. Paying a premium way and above that to take it private just doesn't make any sense. So one of those big sources of deal flow has just completely gone away. You could start to see that come back if you start to see a real price correction.
One of the big overhangs always is all that dry powder that's been accrued by the big managers, really all the managers. Yeah. Does that get pared away soon? How much is that on investors' minds?
So our data says a couple of things. One, today there's about $2 trillion of this kind of dry powder uncalled capital. Seems like a breathtakingly large number, and people are talking about it as it's going to be a real problem. Let's put it in context. 2 data points. One, if you take that number as a percentage of global AUM, it's less than 2%. So our entire asset class is less than 2% of the global AUM. The second data point I would throw out is, even at today's investment pacing, which is not anywhere near record levels, that capital would take about 3 years to deploy. None of those sound scary to us.
Right. I'll tell you one area that's been scary for a lot of people, hedge funds. Over the last year and even over the last few days, we've started to hear more and more about a lot of exposure to hedge funds, especially into the tech stocks. Does hedge fund weakness provide an opportunity for private equity to make their case to big institutional investors?
I think, frankly, the hedge fund weakness that we've seen over the last decade relative to the other markets has really benefited the private equity side, which is you've just seen capital flows. You have seen hedge funds basically losing kind of market position in terms of capital raised, and you've seen those dollars migrate over, and you've seen the private equity industry benefit from that. I think that trend is likely to continue. I think investors fundamentally like the alignment of interest more on the private equity side than they do on the hedge fund side. And as much as our industry is not exactly known for its transparency, it's still a lot more transparent than the hedge fund side.
So before we were obsessively talking about market volatility over the last couple of days, we were obsessively talking about interest rates.
Right.
Obviously, all eyes on the Fed, including the president's, notably. What does the potentially changing interest rate environment do positively or negatively for private equity?
I think here's where we split, kind of the private equity side versus the private credit side. On the private equity side, a rising rate environment historically has actually not had much effect on the overall return. Essentially, rising rates kind of get passed through to the seller, and you see purchase prices tend to come down a little bit. I would expect that that's what we'll start to see as pricing cools off, as it is in the public market. Same will happen in the private market. I think on the private credit side, it creates another whole set of opportunities. And you've really seen kind of an explosion of capital raising on the private credit side. I think we're still in early innings, despite that market raising a lot of money. I think that's going to continue for a long time.
So let's stay on private credit for just 1 minute, because that has been a fascinating just boom town, boom area.
Huge.
Why?
Well, I think a couple of reasons. On the public credit side, people are struggling to hit returns that they find satisfactory. Those returns have been pretty anemic. That has not been at all true on the private credit side. Now, the immediate reaction from people is, oh, they must be taking a lot more risk. No, what you see is a much more inefficient market that frankly has been underbanked. Now, maybe it will start to become overbanked again, but you've taken out a lot of players due to regulatory changes, and you've basically split that market wide open where the inefficiency is kind of rampant, and people are taking advantage of that.
All right, so talked about returns a little bit. Returns coming back for private equity, or are they sort of where they're going to be going forward?
Well, you've basically seen private equity still generating kind of a mid-teens performance on kind of an after-fee basis. I think most investors would find that very attractive. Now, in years when the public equity market is posting 20% rate of return, getting 15, I think, starts to have people question illiquidity and duration. I don't think anyone believes that the public equity market's going to keep doing that forever. And so I think mid-teens over a long period of time looks pretty good.
Last question for you. Fees. What are you ultimately paying for this? Do people expect that the cost of all this is going to come down in the near term?
It's been coming down, but not coming down much. This industry's been incredibly resilient around that for a few reasons, and it really goes back to the performance. Investors are still measuring this on a net fee basis, and the returns on a net basis look very attractive. And so that power sort of falls to the GP side. As much as we'd all like to pay less, in that kind of a market environment with that outperformance, they're not willing to give it for less.